Yeah, I feel the participants were very inquisitive, and that's a very good sign. I mean, normally in such conferences, half the people are, not that much interested in the sessions. But here I find that, there's a lot of inquisitiveness, and still I think my presentation is over almost half an hour back, and still people are not leaving me. So I really appreciate that. See, it's actually like this, that there's nothing free. There's no free lunches. So as they say, it's a facility available. Obviously, in case you want to avail of this credit, there are certain charges. You have an option. You don't have to avail collateral free loan. If you have a collateral to offer, you can offer that collateral and take a loan without paying these charges. But suppose you don't have a collateral and you need money to grow your business or to do business. So what is the option available? You need money desperately and you don't have collaterals to offer. Then CGTMSE Credit Guarantee Fund comes into picture. So you pay a very small, it's 1.5% one-time fee and a 0.75% annual fee which is payable. More than the business model, in case you are looking for a debt funding, the business models are definitely important, but more than that, your track record is important. Any bank, in case they are giving you funds, they'll look for your balance sheet for the last 3 years, they'll look for your IT returns, they'll look for your CIBEL score. So your track record, both in terms of credit history, as also in terms of your business that you have been doing, it's very important for taking a bank loan. And obviously, the project which the bank is funding, it has to be viable. So it need not be a very high growth, high risk kind of a thing, which typically an equity guy will look at. They will basically want that they'll not fund a normal typical business with a low growth rate and low returns and all that. Bank will fund it because bank wants to contain the risk. Equity guys want to take lot of risk and expect lot of return. So the models are to that extent slightly different. A very high risk kind of a venture, bank will perhaps shy away from funding. Our focus is more on the promoters, because ultimately it's the promoter's reputation which is at stake when he's taken a loan and given personal guarantee. So even if sometimes we feel, based on our experience, that businesses fail, the promoter will not like that liability to remain on himself. He'll from somewhere arrange the funds and make the payment. So we focus more on the promoters and leave the rest to his judgment. Because unlike a VC, the amount of time he spends in assessing a proposal is enormous. Maybe a typical VC, if he does 10 cases, a typical bank in that time will do 100 cases. So we have limited time to assess and go deeply into the project. So broadly, we look at the promoters, his credentials, his track record, his credit history. See, again, one has to understand is that your credit report can be for maybe for credit card loans that you have taken or personal loans that you have taken, 10 lakh, 5 lakh, and those kinds of things. So one has to understand is, one is your credit worthiness, the other is the quantum of credit which the bank can trust you with. So suppose you have a very good credit history with credits not exceeding 50,000 to 1 lakh, and you are going for a 5 crore kind of a loans, that will not be very important in the overall scheme of things. So proportion is not matching. But at the same time, if the small loans you have been defaulting and your payment behavior is not very good, you are delaying payments or you are defaulting in payments, there are write-offs appearing in the CIBEL report, obviously that will